Hello, everyone. We are doing a mini-series of podcasts here at the Wharton School on the future of finance. And today we are going to explore a new phenomenon, behavioral and social investing. Of course, behavioral investing is not a new phenomenon. We have known about it and talked about it for a long time. The new element that has come into it more recently is social investing. How behavioral investing is assisted by social media and the desire of people to participate in a social phenomenon, kind of like a cultural phenomenon. And we saw different episodes of this with meme stocks, starting from GameStop and AMC and others. And we have the best guest to dive into all this. This is Matt Levine, who is a columnist at Bloomberg and the author of the very famous Money Stuff newsletter. Hi, Matt.
Hi, thanks for having me.
It's great to have you. And I'm here, Itay Goldstein. I'm a professor of finance at the Wharton School and currently the chair of the finance department. And I will conduct this conversation with you, Matt. Looking forward to hearing from you. So in your May 13 issue of Money Stuff, in which, by the way, you generously link to the Wharton MBA curriculum, you ask the audience, is this just how life is now? So I will turn it over to you. Is this the case? Are we going to expect more of these GameStop sagas, or is this just a unique phenomenon?
My gut is that it is more the former, that this is kind of the way life is now. I think that GameStop was sort of a proof of concept, but really ultimately Bitcoin and crypto were a bigger proof of it, that something like social investing can work. I mean, sometimes the way I think of it is that for most of the history of financial markets, people thought of like the stock market as this sort of social gambling game where you were trying to outguess the other person. And then there was almost a brief blip of like scientific finance where people thought, oh, stocks are worth the present value of their future cash flows. And we've now kind of gone back to the old system where stocks are worth what you can get someone else to pay for them. And people realized that you could harness social media technologies to collectively influence the prices of stocks. And I think that that just kind of remains true. I don't think you'll see GameStop again. Like the real insanity of that was kind of because it was the first time and because it was such a novelty. But the basic idea of like memes can drive the prices of financial instruments seems pretty like well established in crypto by this point, to the point that it's like not even newsworthy. And it's, it continues to reverberate through the stock market.
So this is very interesting. So basically what you are saying is that our models of finance where the value of a stock is going to be determined by the present value of future cash flows. You say this is a blip on the timeline of financial markets, and people are used to think about it in less scientific terms, and this is what we're going to see going forward?
I'm probably exaggerating when I say that. I mean, I think that one thing that the GameStop episode taught you is that, there's good reason to think that the present value of future cash flows of an asset sets some sort of like floor under the price of the asset, because if it goes to zero, then someone can go buy it and extract the cash flows themselves. But I think people sort of developed this like rational system where they assumed that the present value of the cash flows was also a cap on the value of the asset. And like that's just, there's no real reason for that. And if a lot of retail investors want to bid up a thing for years at a time, then I think what you learned in GameStop was that there's not really a clear corrective mechanism, right? It's not like short sellers can come in and force the price down to a rational level. And I don't know, that to me is the lesson. Like there's not a corrective mechanism in the short or medium term for just a meme driven price.
Right. And it's very interesting that you draw the parallel to Bitcoin and crypto assets because, when we talk about Bitcoin in the classroom, we say that there is really no clear way to price them. So there is really no way to tell what is the right price for Bitcoin. So you think basically that Bitcoin and other cryptocurrencies are maybe the central phenomenon, and GameStop was maybe one other example of that?
I kind of think that. Yeah, I kind of think that like GameStop being a stock that moved on like a coordinated social movement for a few months was really interesting and like sort of brought it to closer to the financial mainstream. But uh that's also true in a less silly but more important way of Bitcoin, right? I mean, like, you know, when you talk about like how you value Bitcoin, it is like any sort of legitimate any real effort to value it is going to be based on its social adoption, right? If people buy it, then it's worth a lot of money, and if no one believes in it, then it's not worth a lot of money. And that is the sort of core of what happened in GameStop, right? Where like GameStop was also a company, but like the sort of real meme driven stuff was about just like the its popularity in a social investing universe. Um, I think that Bitcoin is the clearer illustration of how strange this is and how like enduring it is, right? I mean, Bitcoin has had a five-figure valuation for years now. Um, its social adoption is enough to drive the value in a way that it wasn't really for the long term for GameStop.
Yeah. So, when we talk about it as economists, we would think about it as kind of a coordination problem where if everyone thinks it's valuable, it will be valuable. If no one thinks it's valuable, it will not be valuable. And then it can kind of end up anywhere in terms of price. And you're right.
And Bitcoin is sort of like self-consciously that, right? It's like it's meant to be a currency, right? So it's like sort of everyone understands that it's a coordination problem. Whereas there's no reason for GameStop to work that way. It just did for a while.
Right. Yeah. Exactly. And this is, I think, where the deviation is. That with GameStop, there is a way to price it that is not based on coordination. With Bitcoin, there isn't. But the fact that this migrated into GameStop and AMC was really the new thing, and maybe the very interesting element here. So diving a bit deeper into that, what do you think are the sort of psychological and social triggers that were behind the AMC and the GameStop saga? How would you characterize them?
I do think that there is uh, there is a cultural moment that is somewhat pandemic driven, right? I mean, a lot of people were stuck at home. They had a lot fewer entertainment options. They were sort of turning to the internet for entertainment because, you know, sporting events and television shows were canceled and like live events were canceled. And so it was easier, you know, there's like a lower bar for entertainment. So like going to a message board and talking about trading GameStop options was relatively more entertaining than it would have been at any other time. Uh, and it was just like a real uh you know, it fed on itself in the sense that like uh people were having fun trading GameStop went up, this got attention, GameStop went up more, and then it became like a truly insane event where people were making, you know, 10,000% returns in a couple of days. And so that attracted a lot of people, right? It was a combination of like people were making a lot of money very quickly. And also they were just very evidently having a lot of fun doing it that attracted a lot of people. So like one thing that happened in GameStop is that the stock went up a lot. But another thing that happened is that the number of users of the Wall Street Bets message board went from like, you know, under a million to like 8 million people in a couple of days. And that just, you know, it was in a time where people were starved for entertainment and starved for like social interaction. That was a very fun place to be socializing. And like the coin of socializing there was you buying and holding GameStop.
Right. So this is all sort of pandemic era driven, as you say. But then when you saw this coming back in May of this year, what were you thinking?
One thing I was thinking is this can't work as well again just for like entertainment reasons, right? Like it's just not as fun the second time. And it wasn't, right? I mean, like people were interested in it. And, you know, what happened is that Keith Gill, the sort of like uh influencer who was the main driving force behind the first GameStop rally. I'm not sure that's true. He was the mascot of the first GameStop rally. He came back to Twitter to sort of tweet inscrutable things and to sort of uh, try to get the band back together. And people were interested in the stock shot up and GameStop was able to do an at-the-market stock offering, but it was never, it didn't have anything like either the financial or the cultural impact that it had the previous time, right? I mean, the stock did not go up that much, and it got attention in like the financial press, but it was, the sort of original GameStop rally was, it was on Good Morning America. It was like the biggest news story in the world. Keith Gill coming back was like a financial niche news story.
Right. Um, so, when we analyze financial markets, we tend to think about retail investors and institutional investors. And the usual thinking is that institutional investors are going to be more sophisticated, they're the experts, they have time, they have money to do the research, and at the end of the day, they will know how to pick the stocks. And then the retail investors are those who are maybe more naive. They don't have the financial resources to make the right investment. At the end of the day, they might be taken advantage of. This was not exactly how things played out in these episodes. So, did these episodes lead you to reconsider the way you're thinking about institutional versus retail investors?
I think that it suggests that retail investors have more power than you would have expected, right? Like I have read for years people saying, on Reddit or whatever, um, people talking about gamma squeezes, right? Like saying, if we all buy call options, then that will force the price of the stock up, and dealers will have to hedge their call options by buying more stock, and then the stock will keep going up, and the dealers will have to buy more to keep hedging, and the stock will sort of spiral up infinitely. And I would read that and say, okay, like there's no perpetual motion machine, but also like how big of an impact on a big liquid stock can retail call option buying have? And the answer is like much more than I expected, right? It's just the you think of like retail investors as being like dispersed and kind of random, right? Because they're traditionally don't have access to a lot of information, but they're also just like individuals with small accounts. And one thing that you learned in the GameStop saga is that uh, retail investors can kind of coordinate around one thing where they're all buying the same call options of the same company at the same time. And then the stock really does go up. And the stuff about gamma squeezes that sort of like looks like an urban legend turns out to be kind of true some of the time. Uh, so I think that has been an interesting shift where retail investors like just have the power to move markets in a way that nobody really expected. And you see that in like institutional investors being much more cautious about short selling, and particularly like, vocal activist short selling, because they worry that if they go after a company, if they short a company, some retail investors on a message board will say, let's go after that hedge fund. And like it turns out that if they all do that, then like it can have a material effect on the hedge fund. Um, your question, you talk about like, retail investors being less sophisticated and having less access to information. I, I don't know that like the retail investors like in the long run look particularly smart from the GameStop episode, right? Like it's not like GameStop is killing it in their business. Um, I think there's like interesting effects where like GameStop and AMC were able to raise so much money and sort of like get some runway from their retail involvement. And like that has interestingly shifted the dynamics of the underlying businesses. But like ultimately, I don't know, the hedge funds who were shorting GameStop, I don't know, the hedge funds shorting GameStop at like $14, maybe they were wrong, but the hedge funds shorting GameStop at, $80 seemed right, but they also got blown up. And I don't think that like this is a story of retail investors being better analysts of companies than professional investors, but I do think it's a story of like retail investors coordinating in a way that is much more impactful on the market than anyone really thought.
Yeah, I completely agree. I mean, it's not that they did the underlying analysis, but it is that when they come together, they manage to move markets in a way that puts institutional investors in a bind in a way that they didn't really expect. So I think in that sense, it's a little more subtle than the traditional story we had about retail versus institutions.
Yeah, I read a lot about like market structure and about like uh high frequency trading firms market making to retail traders. and like everyone's model there is that retail traders are, oh, sorry, I shouldn't say everyone's model. The popular perception is that retail traders are sort of like random noise traders where like they'll buy a stock, they'll sell a stock, but there's no like overarching coordination among retail traders. And so you can like make a lot of money market making to retail traders because like they are like, buying at the offer and selling at the bid and uh not like predictive of prices. And you see in like I don't really know how market makers did in this. I think they did very well for the most part. But like you see in this that retail trades are like much more predictive than people would have thought, right? Like that they are that there is a directionality to retail trades where like if one retail trader like sometimes if one retail trader buys a stock, that is a sign the stock is going to keep going up because a lot of other retail traders are going to buy it. And that's just like an interesting shift where, you know, like a retail trader is not an atomized individual buying stock sort of like independent of all other retail traders. There is like this ability for retail traders to coordinate.
Right. So you mentioned the fact that AMC and GameStop were able to raise capital out of this increase in stock price. And at the end of the day, for example, in the case of AMC, this led them to avoid bankruptcy, which I think was a real concern at that point. And I think this raises a very interesting question because at the end of the day, if this just stays in the financial market, some people make money, some people lose money, you can say it's okay. People go to the financial market at their own risk and they should be prepared to lose money. But when this kind of spills over to the real economy in the way that it did here, because you have a firm that is able to raise more capital and stay in business even though maybe it shouldn't have, then I think this raises deeper questions. Are you worried about that firms are using this phenomenon?
I sort of put myself in the shoes of the CFOs and think, well, how could you not, right? I mean, how could you not try to raise money here? I also think that, you know, it's an interesting, I mentioned earlier the idea that there's no mechanism to cap the price of a company at its like cash flows, right? Like there's no mechanism for if retail investors all want to buy a stock, there's no mechanism to prevent the price from going to, as high as they want. But of course there is, which is the company can sell the stock, right? And you see a little bit of that in some of the meme stock episodes where like if the price gets too high, the company is going to hit the bid and then the price will come down to a more reasonable level, in part because like there'll be more supply, but also in part because like it sort of deflates the social phenomenon. If everyone's like, oh, we're buying and holding, and then the company's like, we're a seller at this price, it's like sort of bad for the meme. But uh, I think it's probably bad if financial markets are allocating capital on retail whims. So it's not that bad, right? I mean, like there are other like forms of gambling and that are probably, you know, equally expensive. And like there's something interesting about AMC, right? Because like on the one hand, their business was struggling and they got a lifeline from meme stock investors. On the other hand, like those meme stock investors were not driven by like pure irrationality. They were driven by like nostalgia for movie theaters, right? And their business was struggling in part, like there were other problems, but in part because they were in a pandemic where they couldn't show movies, right? So the idea that like these retail investors driven by nostalgia were sort of bridging them through a difficult business period, like it doesn't seem that bad, right? It seems like in some ways, like the retail investors like made a sort of like rational allocation of capital there. Um, I do think that you can look at some of these. There's like a real cynicism to some of the capital raising off of meme stocks. Uh, but at the same time, like, the most cynical looking of, well, I shouldn't say that. One very cynical looking trade was when Hertz raised money from meme stock investors while it was in bankruptcy, which is just a crazy thing to do. But also like it emerged from bankruptcy with equity value and those meme stock investors made money, which is again, like it's a pandemic driven thing where like the business crashed and then recovered and the meme stock investors sort of bridged them through the pandemic. There are other cases. I mean, Bed Bath and Beyond is a case where they raised money from meme stock investors all the way to zero in a way that looks really cynical and looked really like a transfer of money from uh, retail investors to essentially bondholders. But I don't know how big of a misallocation of capital it was because they did go bankrupt in pretty short order.
No, you're making good points here. I mean, I think it is clear that this meme stock phenomenon can help firms go through a bad time. Whether this is good or bad, it's not clear. It depends on whether the underlying stress was efficient or not. And yeah, certainly there was some business proposition behind AMC staying alive. So in that sense, maybe the investors did them a favor.
If your model is that like the retail investors doing this are just always like systematically less rational than institutional investors who normally fund companies, then yeah, this is bad. I think that model is like, largely correct, but it's not like so obviously correct, right? I mean, institutional investors make mistakes too.
Yes, absolutely. I would be the first one to agree with that. So if you are a regulator sitting and watching all this, what are your main takeaways? What do you think should be done to make financial markets more orderly?
I'm sympathetic to the actual response of regulators, which was kind of that this is all fine, embarrassing, but fine. Like, like when the GameStop thing originally happened, there was a lot of interest in whether there was some sort of like secret coordination pump and dump where uh, the people on Reddit touting GameStop were like secretly, doing something nefarious. And it doesn't ever look like that was true, right? It just looked like they liked the stock. There was maybe an awkward amount of coordination, an awkward amount of cheerleading, but like no one was lying really. And that's like the main thing that the SEC is concerned about is like people misrepresenting things or lying. Um, this strikes me as like kind of an emergent phenomenon of retail traders and one that like kind of can't be regulated away because it's like uh if people want to put their money on this thing, then they're allowed to. Now, you see, like, there's tinkering at the edges, right? I mean, like one thing that came out of this was the move to T+1 settlement, which is a really arcane response to the GameStop saga. But like, you know, basically the GameStop like phenomenon led to increased credit risk of clearing because everyone was buying the stock at like at this incredibly volatile stock at like increasing prices, and so that led to like hiccups in the system of like stock settlement where like Robinhood was getting giant margin calls from the clearinghouse, and so the SEC subsequently moved to T+1 settlement to kind of like tamp that down. Another response you saw is that the SEC sort of expressed very clear skepticism about companies raising capital off meme stock things, and they sort of demanded that companies put a lot of like uh, uh, dire warnings in their prospectuses when they did these offerings. But of course, when you do a retail at the market offering, zero of your investors read the prospectus, so it doesn't really matter. Um, I don't know that there's much that they can do. And I do think that, like, again, this was like a thing that happened during the pandemic as a sort of like entertainment substitute. And you look at what entertainment options are available to people these days, like it's a lot of gambling. And so like I'm not sure that like investing in GameStop options is that much different or that much worse than betting on sports. And so like the regulators are in a bit of a bind. I think it's very embarrassing for the SEC to have this occur because they would love for financial markets to just look more orderly and rational and less like an insane entertainment product. But people are coming to the stock market for a lot of reasons, and one of them is clearly entertainment.
Right. Yeah, no, I think they will have a problem thinking about the stock market as a casino. They would like it to be a place where allocation of capital is being done, and I think this is why they look at it and are a little worried by that.
I think that's right, but I also think like the SEC has such a bias and mission in favor of retail investors, and that includes letting retail investors do what they want, right? I mean, like if your goal was efficient allocation of capital, you might be sort of skeptical of a lot of uh, retail investor decision making, right? You might be like, everyone's got to put everything in an index fund and only professionals can trade stocks, but that's like not the American way. And I think that there's a bias towards letting retail investors do what they want, even if the SEC is sure it's bad for them. I also think that, like, I talked about Hertz. The SEC stopped the Hertz equity offering, and that offering like turned out to be a good idea for the people who were buying it, right? I mean, like the stock, in the sense that the stock went up, right? So the SEC like doesn't always know what is irrational for retail investors.
Yeah. So, to close our conversation, I want to ask you more broadly, where else do you think we are going to see episodes like this? And I want to bring up something that is related, but also different in many ways. And this is the Silicon Valley Bank that, had the biggest bank run in history. And it was also driven by social media. Of course, this is not the stock market. It's a bank, people pulling out deposits. But at the end of the day, there were some similarities because of the contagion that happens through social media. So do you see some connection? Where do you think we are going to see more action along these lines?
Yeah. I mean, SVB, I think SVB is interesting because like SVB collapsed because of a bank run, and the people doing that bank run were largely like very sophisticated, well-connected, sort of VCs and tech startups who are like, largely the depositors there. And people talk about it being a social media driven bank run, but I think a lot of like my gut sense is that a lot of what happened there was not happening on like Twitter, but on, private text messages or just like phone calls between VCs, right? So it's not exactly social media driven. It's like a fast tech intermediated sort of traditional rumor mill. The interesting bank run from a social media perspective was like Credit Suisse before it collapsed, like not the day before it collapsed, but in the months leading up to its collapse, there were a lot of like, you know, Redditors trying to take down Credit Suisse. And I do think that like the possibility of coordinating a bank run on social media is interesting. It is, as you say, like the inverse of the meme stock phenomenon, where you know if people on social media can get together to drive a stock up, they can get together to drive it down. And in general, as I said at the beginning, like the cash flows are a floor on a stock price, right? And like you can't really come together to drive the stock price of like Tesla to zero, but you kind of can with a bank, because banks are so like perception dependent. And if you have a bank run, then like the bank really can go to zero. So I do think that like the possibility of using social media to coordinate a run on a bank is like, something that occurred to people after GameStop, and something that like kind of sort of tentatively played out a little bit in Credit Suisse, although I think ultimately it was not like the causal problem at Credit Suisse. Um, in terms of more generally, like where does this go in the long term? I mean, I think that uh, the two things I'd point to are, again, crypto is just like uh, people have developed a better understanding of the social dynamics of investing, and like that's going to just keep being reused in crypto. And then the other thing I'd point to is Donald Trump's SPAC, right? Which is, GameStop is a real company, which like you could have a range of opinions on how much money GameStop will make selling video games in 10 years, right? Donald Trump's, Trump Media and Technology Group is like a real like teeny nub of a company, right? It's got a social media site that doesn't seem to bring in very much revenue. It talks a big game about like getting into streaming video and other things, but it's like not clear what they're doing. And on its very, very small revenue and sort of like minor, like small negative net income, it has like a multi-billion-dollar valuation. And it's just very clear that the people buying it are not buying it because they're like doing financial analysis, but because they are trying to get behind Donald Trump in some way. And I think that like, I don't think he'll be the last person to make use of this phenomenon, right? And I do think that like GameStop kind of proved out the possibility here, and then Trump Media Group capitalized on it.
Okay, lots to think about. Thank you very much, Matt. It was a pleasure talking to you about all these issues, and I think we should all stay tuned to see what's next.
All right. Thank you very much.
Thank you.